I said I'd give you a 10-second countdown and I didn't, sorry.
You did not.
Okay, and we are live. Welcome everyone to another edition of Wine and Whiskey Wednesdays.
Cheers.
With your hot
Cheers,
ninjas.
welcome.
So cheers everyone.
Cheers.
Hope you've all had a great week. Yeah, so we weren't online last week. Steve and I took a mental health Wednesday night, and so ended up not being live. And just to throw it out there into the universe, everybody needs a mental health day. So do take it when you need it. The world will continue to move on, even if you take a mental health day. But we're back, and we have a special guest with us tonight, Louie Prosperi. So welcome, Louie. Thank you for joining us.
Well, thank you for having me on. This is a real treat for me to be up at this time of the night and be awake. So this is good.
It's 8 o'clock. You're Eastern Standard. And welcome back, Michelle. And of course,
thank you.
Of course, is here with me. So tonight our topic is going to be about building your dream practice. Bookkeeping practice, accounting practice, doesn't matter. And Louie, you may know from being the past CEO of IPBC as well as ICB US. I'm sorry, my dog is walking around, but I'm not sure why. Usually he's already settled on the cushions and made his way, but seems to be looking for something. And now, Louie, you are also coaching. You're sharing all the wisdom that you've gained over the years in your various roles and helping to build or helping other accounting professionals to build their practice. So why don't you tell us a little bit about yourself? I gave a really short intro there. I'll leave it up to you to tell us what you'd like to share about your background as well as what you're doing now.
Oh, okay. So basically, I think for about the past 9, maybe 10 years, I've been working with the IPBC and ICB as the CEO with regards to professional bookkeepers and getting them certified and helping develop a standardization for professional services. During that process, when we were developing these associations, one of the core things that kept coming up is the need for professionals to be very good at what they do and to be experts is great. And IPBC and a lot of other organizations do that. But the real difficulty where I started to focus on more and more when I was in the Institute was looking at helping them build the proper business, because the expertise and knowledge is essential for you to deliver, but running a professional business is completely different, and the skill sets and how to value and how to effectively communicate your value is unique. So during the last 9 or 10 years, through those associations, what we've done is we've developed programs, and I'm sure you're aware of some of your people might be aware of the Black Swan program or the value pricing. Intuit did Firm of the Future, which you guys won. Congratulations on that. And with all of these different components, what I decided when I left was to help organizations build the right practice. Where I'd like to start off with is the knowledge. What you are is what we call a knowledge professional, and your services are knowledge services compared to what we call regular services. Regular services is basically an exchange, and you get something like coffee as a service, your mechanic is a service, but knowledge services is basically comprised of your expertise and your knowledge and the transfer of that to the customer and how it impacts their lives. And it's the impact that's the big value component. The focus there is when we look at the value is an external component because it's based on the impact of each customer that you interact. And as we know, each customer is different. So what the knowledge workers' mechanisms to transfer that knowledge is tax return, bookkeeping services, like reconciliations and all of that. You have cash flows and compliance work and payroll work. That's not exactly, that's just the mechanism of transferring the knowledge. At the end of the day, it's how that knowledge impacts the other customer. And that's the big difference once you understand that component and focus on outcomes, then there's a mind shift in the professional, and they tend to have a much better way of servicing their customers, pricing, finding the right skill set that they need, setting up the capacity issues and how they want to set up the services, the type of customers they want to build. So it is really the core component. And then you go from there. And what I've done this year is basically coached a series of firms, both bookkeeping and CPAs, and helping them do that transfer.
Excellent, excellent. So you've already dived into a bunch of the topics that we're going to cover tonight. But let's start with, okay, so our topic tonight is building your dream practice. Let's start with, where do people start? And when do you start? Do you start when you've just opened your doors? Do you need to be in business for a while? Do you need to have a staff? At what point are you starting to think about building your dream practice?
All of the above, I guess, because it all depends on where you are in the process. I like it if you can start at the beginning, that's great. If you're just starting your practice, one of the best ways and we could talk about capacity, one of the best ways to do it is you determine two things first off. Actually three things. You determine what's the revenue stream that you want to make, right? What's the top revenue number? How much money do you want to take home? And whether or not you want to be a sole entrepreneur or you want to add staff. And we normally start off as a sole entrepreneur. So the first thing we do is we find out how many customers we can have. The reason why you have to do that calculation at first is because if you just take on any customer that comes walking through the door and you're not managing the customers coming in, the customer base ends up dictating to you what your capacity is and what your revenue is, rather than you building the right capacity. So
okay, so hold on. So is our starting point actually the planning of what is our top line revenue is that we need to make or that we want to make?
Right, that you want to make.
That you want to make. That's your starting point. Then working out what your take home after all your expenses is.
Yeah, how much you want to make net.
Okay.
And then the third part is, how many customers can you manage? Let's start with just you on your own. Let's say this is an entrepreneur who's just starting out. How many customers can you manage, right?
Okay.
So that you can get an average revenue stream per customer.
That's great, because nobody does that. Or I'm going to say the majority of the people don't do that. And most people, as you said, customer comes knocking on your door, you get a referral, word of mouth, you have your first customer walk through the door and you say, yes, of course I can help you. You don't look at what what the revenue is that they're going to bring to you. You don't look at anything beyond, I got my first client. Mm-hmm. So absolutely, that is great advice. I mean, we did that, right, Steve? I mean, we were very much about, sure, you want us to do anything to do with numbers. Sure, we can do it for you. Excel, business visions, PC law, it doesn't matter. We weren't forward thinking at all. So that is a great starting point. Okay, carry on. Sorry.
No, that's good.
I just wanted to draw attention to that.
This is good because I tend to sometimes skip ahead. So this is fantastic. This works really well. So let's look at that example. So let's say you want to make, I don't know, 100,000, let's say $150,000, right? I'm going to need a calculator here.
And 150,000 is your net or your
top line?
Top line.
And let's say you're looking at about $40,000 in expenses, which is training, office, and all of that stuff, right? So it's 110. But at $150,000, now you go, how many customers can I handle at that 150? So the first thing you do, let's say you can handle 40 customers. So you take the 40 and you divide it by 4. You take the 150.
You didn't take easy numbers, right? You didn't say like 150 and 15.
Yeah, I know. So you take the 40 divided by 150, it's 3,750. So what
Okay.
that means is your average customer has to be, for the year, has to be almost $4,000. So what you have to do is, that doesn't mean you can't take customers below there, but there's only so many that you can take below that. If the majority of your customers is under $4,000, you're never going to hit your targets. So what that allows you to do is when a customer comes through the door, do they hit that threshold, right? And the great thing about making that your minimum price is that you're going to get to the target that you want. So you can always, I like using the average price when I do the calculation as my minimum price for the customer that walks through the door. Now the question is, so I got a number. Now the reality is that that number, or that dollar value, now has to have an attached value to the customer that's equivalent or exceeds that number, right? So,
Okay, so before you move forward, so let's talk about this. So 150,000 is what you want to make as a solo.
top line.
And top line, 150,000 is your revenue as a solo. So that, for most of the audience, is a fairly ambitious revenue target. But would absolutely, I'm sure, love to make $150,000 in revenue a year. Your average that you worked out, assuming that there was, 30,000 in expenses, is at $3,750 per month. I'm sure that there are people that are sitting there watching going, I've never been able to charge $3,000 a month to any bookkeeping client.
No, that's per year. That's per year, right?
per year.
3,750 is per
okay.
year.
Perfect.
Yeah.
Okay.
There's
No
you have 40 customers. So the average per month would be divided by 12.
Okay, that's
would be about
realistic.
$350 a month.
Okay.
But
Perfect.
you have to have 40 customers. The question is, can you handle 40?
Too much math and too much wine this afternoon.
Sorry.
Okay. So $350 a month, much more realistic for a lot of people when they're looking at bookkeeping. I can do $350 a month, no problem, and I need 40 customers. Okay.
Yeah. Yeah.
Next step.
I think one of the challenges is, I think where people perhaps, I guess, overestimate like how many customers they can help. Like, are there some good guidelines you found, Louie, for determining how many customers, right? Because every customer is different, right? I mean, I can have one customer, who's taking me, 2 hours a week. I can have another customer who's taking me 2 hours a day. How do we average? Is there any sort of a formula? Is it your best guess? Is it it's something that's constantly in motion? You're reevaluating as you go along? Because I can see somebody, saying, okay, I can handle 40 customers. And they find out that their first 20 are already taking them 50 hours a week.
Correct.
So now what do I do?
Right.
And I priced those based upon I can handle 20 more.
Right.
Sorry, I hope that makes sense.
No, actually that's good. So the other part of it is, how many hours a week do you want to work? Right. So that's your capacity limit. When we talk about capacity, that's when we start looking at hours. When we build value, we talk about value. Value is not based on hours, it's based on outcomes, right? Yep. But the effectiveness of the values, how much time can you spend? So if you want to work 40 hours a week, then again, that's your average, right? The 3,700 or 4,000 is your average. So that means, let's say the most you can spend per week or per month on a customer is 5 hours a month per customer, right? So if you have that limit, then what you have to do is adjust. So as soon as someone goes over 5 hours, you have to adjust the price point to compensate for that difference. So you will have to analyze this. So your first customer might be a $1,500 or $300 or $150 customer. That's fine. He's on the bottom, but you can only have maybe 5 or 6 of those based on the rate of return. So it's the next best thing to think about is think about an airplane. And think about an airplane as your maximum hours that you can work. And you have different types of seats, right? If you look at the front end of this, the thing that's the VIPs, if you notice, there's not that many VIPs there because they take up a lot of energy and time. They charge a lot, but it's not the same amount of space between each VIP compared to first class or business class and then economy, right? So that's what you have to factor in. So if you have 40 customers, that's fine, but maybe you can only have 10 customers at $200. And maybe you can only have 5 customers at $1,000 a month because that's all you can have to handle. So when you determine your average, that gives you a starting point. The next thing, as you start filling up the plane, you have to keep reassessing where the value is and where the plane is. And sometimes you've priced it wrong. So you've priced an economy guy and you put them in first class. There's not much you can do about that without either getting rid of them or price increasing it. But you'll know that as you grow your practice and understand your value better. So that's a good question. And that's the other part that you determine, right? So
I absolutely love that analogy of the plane.
Yeah.
That if you, because it makes it visual for us, that you know you're basically your revenue base and the number of clients that you can handle are the number of seats on a plane, and start putting your clients into those seats to determine how many you have in first class, how many you have in business class, or are all of your clients in economy class and you don't have any in the other two. I love that analogy. So Matthew commented that he had heard it's between 20 and 25 clients per person. So if that's the case, then your minimum has significantly changed as well.
Yeah.
So, and I think, I mean, I'm a member of a whole bunch of Facebook groups, and I've had people who've said, you know, that they've been able to, as a solo, that they're handling 60 clients. Some are handling 30, some are handling 20, some are handling 10. And I think that the question that gets missed when it's asked how many clients do you have is every client, as Steve said, is not equal. That you may have a client that is very complex and heavy in payroll, and then a client who is no payroll and straight services, and you're able to automate everything. From a client count, it's one client versus the other, but they have different values. And so visualizing it as the seat in the plane lets you also take that number and slot them in differently. So I love that analogy.
the other thing that we can go just a little with regards to the type of customers. When people say they have 60, some customers say they have about 300 to 400. I usually ask them if they do T1s, and I like to separate the T1 component because that's very seasonal. It's very specific to like 90 days of the year. That's one type of customer base, and you treat them independently. So that would be like your regular plane is your corporate work, and your charter plane or the little plane is your T1 or tax work, right? Just as a way to. So I'm with you, Juliet. 60 customers for a bookkeeping practice for one person is quite a lot.
What was that number that we saw from Receipt Bank, Juliet? Remember? I think Juliet has frozen.
Ah, there she is.
There she is. She's back now.
I left.
There.
I got booted out and came back.
Okay. Yeah, we didn't like what you were saying. Did you hear my question?
I did not. Sorry, I heard Louie's comment and then I got booted out.
What was the number that we heard from Receipt Bank last year? Didn't they have a
40.
number? Was it 40? Okay.
Yeah, when we did those surveys way back when with IPBC, the average was between 25 and 50 was we saw a lot of small entrepreneurs in that range, bookkeeping practices. So 40 makes sense. But it's hard though to service effectively because bookkeeping and year-end work is completely different.
Yeah.
And bookkeeping services are much more, I think, more complex, more interactive, and require a lot more, even with the automation requires a lot more.
Yeah.
So Louie, with that, can you hear me?
Yep.
Yeah. So with that in mind, because I'm a tax accountant, we don't do very much bookkeeping. I'm just wondering, so how do you sort of do that same math if you have a tax practice? Because it's not, like you've already mentioned, it's not evenly spread.
Right. So the value the average is fine. You can actually still do it with the tax practice. What you do is you actually pull out the tax component and see how many customers you have, and then you the first step is you find out what the average is, so you can see what the average is. Most people find their average is way below what they would have liked, because and so that usually what happens is they understand that they're pricing too many people below, and that's a good indicator. So if you have in mind that your average price should be $300 and the average is 250 or 150, that means there's a lot of people below that number, right?
So are you talking a month?
No, I'm talking about your T1 season. Are we talking about?
Oh, okay.
Right? So you still do it, but you do it for that particular thing. So if you have a T2 practice, which is a notice to reader practice, is that what you're talking about?
Yeah, that's exactly what I'm talking about. Yeah.
Okay. So you do the same, you do a similar thing, but you do it for your corporate. What I call corporate for CPAs is their notice to reader, corporate, and review and audit, right? But
Right.
that's their side. And you do that and you find out your average. I would split out the review and audit independent, because those are assurance related and they're slightly different than an NTR component. And most CPAs, I would say 80% of their practice tends to be NTR or that side, right? So because that would be priced differently. And then you get your average there. The whole point of the average is to see if the average ties into what you think should be the going rate. Sometimes most of the time you're not pleasantly surprised.
So
right?
what do you think about something like, you know how Uber does surge pricing when they're really busy?
Yeah.
Like, with the tax practice, you've obviously got some really busy times and some slower times. Do you address that sort of a topic, the surge pricing?
Yeah, I call that access pricing. So
Yeah.
when we talk about, I talk about value pricing and providing options. So throughout the year, it's not fair that the person who pays you $1,000 for the year calls you up and he gets immediate access at all times. Meanwhile, the one that gives you $25,000 has the same access. So you can limit, if you have staff, the $1,000 person can be given to the junior staff, and then they don't get the access. The turnaround time is much slower, right?
Okay.
And there may be no turnaround time during your busy season. So they might not be able to get, like if you have a busy period, none of their corporate work can be done during that period. If they want it, then the price changes. So you have what I call access valuing, and you can put that into your system so that you value based on access, right? Some people don't like that because customer care and so forth, but reality is just like everywhere else, the higher level of person that you get access to, usually there's a premium charge. We don't do that as professionals. I mean, you never do, right? So you should factor that into your pricing, and that will then help you spread out the time, make sure you're spending the time with the people that are paying you accordingly.
Good ideas. Thank you.
You're welcome.
Cool. That's a great question.
So, Juliet, are you there? So, I guess
keep coming and going, and I'm not really sure why I'm coming and going.
Okay.
It is not anything to do with the conversation. Just my internet doesn't seem to be behaving, and I don't know why.
So
Yes. Okay. So we've talked about kind of what your starting point is. Is that any different if you have a team or you have staff when you're working out capacity and you're working out?
Yes, it's very different. For example, when I was today, I was just trying to think of numbers that I feel comfortable with, and these are mine gut numbers. I haven't done research. Well, I've done some research based on my anecdotal information from what I've got from people. But if you're a sole entrepreneur what I would suggest, a way to see whether or not you're optimizing your capacity, 85 to 90% of that revenue that you generate should go to your bottom line, meaning that it should be either your salary or your draw or your profits are combined. So if you're making $100,000, $90,000 or 85,000 should be your bottom line.
So that's if you're solo.
Solo, one person, because you're doing
Okay.
all the work. So you almost get 100% of your productivity, right? When you start having a firm and you start having staff, 1 to 3 employees, the productivity or the amount that comes directly to you is going to reduce to a certain extent. And 1 to 3 employees, an ideal profit range is between 40 to 50%, meaning that if you have 3 employees, 50% of the money should be coming to you, between 40 to 50%. If it's not, you're already what I call in a declining rate of return, because what happens as your revenue goes up and you add more employees, the amount of money coming to you per person plus top line is going down rather than peaking or staying flat, right? And I've seen organizations where they get past 5, 6, 7 employees and they have a negative return, meaning they add more revenue and they add more staff and they're making less money. They just got more problems. So that sounds counterproductive, but that's what ends up happening when you only focus on the top line. We could talk about that a little more. The next level, where if you want to do a quick analysis for yourself, is between 4 to 8 employees. If you're making between 35 and 40% for you, and that includes your salary, by the way, but you. And the other caveat here is 40 to 45 hours a week. So if you're working 80 hours a week, that means you're not really making 30, 40% because you're doing double the work, right? So I'm thinking, so basically 40 to 45 hour work week for you as the owner. If you have 9 employees or above, the average should flatline around 30%. 30, 35 should be your average rate of return, because it's hard to hit 50 at that level. But when you have 9 employees productivity and the top revenue and everything is coming in, 30% of it is coming into your pocket, no matter how many you grow, as you continue to grow, that's a healthy return, right? So if you want to do a quick calc, if you have employees and you don't hit any of these targets, then you have capacity, you've got the wrong customer mix. It could be a pricing issue. It could be resource-based, or allocating too many resources to the wrong group. Skill sets may be inappropriate, you know.
Okay, so let's break this down a little bit, and go backwards,
Sure.
just so that we can make sure my internet connection is unstable. So I'm not sure whether or not people can hear me.
Can hear you.
We can.
Okay. Because I can't see anybody. My screen is completely blank except for me and Matthew's fixed picture. Every other video is gone off my screen. Okay, so let's go back. Let's go. Your first grouping was 1 to 3 employees, correct?
Yes. After
Okay.
after the
So
solo
as a solo,
entrepreneur.
you said that. So as a solo, you said your top line is 100,000. Your bottom line should be 85. As you have 1 to 3 employees, so if your top line is 100,000, you're saying that your gross profit should be 50,000?
No.
Or are
no,
you saying the bottom line should be 50,000?
No, I don't think that's what he's saying. I think, and obviously correct me if I'm wrong, Louie, but the way I interpreted it was that, and I'll use you have 10 employees, you're doing $1 million a year in revenue, then 30% of that $1 million should be going to the owners of the practice in terms of profit and salary and bonuses. But if you're not getting 30% of that top line, then something isn't right in how the business is operating. Is that correct, Louie?
Yeah, that's right. It's
Okay.
so if you have $100,000 and you have 3 employees, you're not paying them much, but but the point is you only have $50,000, $50 to $60,000 to pay them, right?
Okay.
Because you have to
Got it.
take at least 40,000 out of that if that's the top number. So the rate of return has to work that way. And these are guidelines. Some people do better, but
Yeah.
in this past year that I've been doing this, a majority of people are doing significantly lower. Like the average I see is closer to 15, maybe as high as 25%. The people that and the people that are doing these rates, they don't really want to talk to me. They're happy, right?
So Louie, is this for bookkeeping as well as tax? These metrics,
Yeah.
both?
Yeah, this is for professional services in the accounting and bookkeeping world. You know, so CPAs tend to get, they can get as high as on 9 employees, they can get as high as 45%, but I don't see that very often. I tend to see a lot of CPAs in the 20%, 25%, as low as 15%, right? And they have a $1 million practice, right?
And is that with them as the owner still having billable hours?
Yeah, that's them
Or
working.
what does
No,
it look like when?
that's them working, and that's, you know, and then we start going through. They have 200-300 customers, and they have all this stuff. And we look at the average price point is $1,100, $1,200 for, you know. So when you're
Okay, so Apsana asked a question. The percentage that goes to me is including her salary. And I think
it's because you're working and producing, unless you've actually left the business and you're just collecting a dividend and someone else is managing it, then the amount might be lower, but then you're just, it's almost an annuity for you at that point, right? So, but this is you actively involved in your business. The whole focus though, and let's talk about that just briefly, is that the majority of your time should be customer management, right? Which is at the high end customer management, and uh, uh, business development. I mean, and business development is working on the business to make sure that it's working well. I don't know very many CPAs or bookkeepers that have any time on R&D, research and development of new services. They don't spend any time there. And to me, that's like the most important part, because if you don't do that, you're never going to be ahead of your customers, because their needs constantly change. And you may think that bookkeeping and accounting service are static, but the amazing thing with technology, with the different things that are needed, the apps and so forth, the amount of things you can do and provide with just some creativity, and all of you have it, by the way. You just have to let it go, you know, be creative, not be too much of an accountant, just be creative. Is you'll be able to add the added value, but you need time to build those unique services and connect with your customers in a forward thinking way. And if you don't have that, you tend to fall behind.
Well, and I think a lot of practices are like that, where they are going to focus on the deliverable, as opposed to, and they think that, you know, spending time on growing your business isn't necessarily a good use of their time. Whereas you're saying, and I know Steve with his Eisenhower matrix beats us over the head with it at our office, as to how important it is that you pull out that time. So absolutely.
Yeah. Growing your business is not just adding top line revenue for the sake of adding top line revenue. Growing your business is creating more value. So I want to change the terminology. The more value you create for your customer, the more you can bill. And value creation is different than just the dollar amount. Only tracks the value created, basically. But you have to look at value creation. And here's the thing: the number one issue with us is we spend so much time thinking about what we do, right? We're focused on what we do. We don't spend any time on the outcome. What's the outcome to what we do? We tell our customers what we do. We're very good at what we do, but we don't spend any time on what is the impact of what we do to the customer. And that extra step is like everything. It's like the secret sauce. It's like that component will decide whether or not you're going to make money or not. And here's the thing. You do a bank reconciliation for a customer and they don't need it. You did a really good job, but they don't need it for their purposes. And you've done it because that's what you have to do according to whatever you thought you did, and you charge them for it. And the value to the customer is zero. So why is he upset? Well, because we focused on what we did. We didn't focus on the outcome. So what you have to do is when you provide a service, your next phase is what impact does it have to that particular customer? If you don't do that, then the value is so different. And all of you know this, right? Because one customer pays his bills constantly, the other one's always complaining. And sometimes it's just a bad customer, but at other times is you're providing zero value for them. And you don't know that because you're so busy thinking about what you did. And that's why one of the things I really push is the value conversation and understanding your customer.
My business really helped change when I read what you're reading kind of makes sense. I read an article ages ago about, I think it was from Receipt Bank actually, and it said 30, 30, 30, 33% for direct costs, 33% for your other costs, and then 33% profit. And that gave me permission to look at my clients and the ones that didn't make that, either figure out how I can or price adjust, or they have to go. And that kind of gave me permission to make a profit and be okay with that because someone else said it was okay. Ridiculous, but you know what I mean? Like, I'm not being greedy. That is what it's okay. And that really helped me that way. And then the other thing, what you said too, like there was a time where I'm like, I don't know if I want to grow. Like, it's so complicated and whatnot. But then I realized growth wasn't, because I was focusing growth was just top line number. And then when I realized growth and business development is more about developing the systems and everything else and getting that cleaner and getting that tighter. And that's, so then all of a sudden growth became fun because I didn't want to necessarily add more clients, not necessarily. That wasn't my end goal, just more didn't motivate me at all. But when it came to cleaning it up and organizing and getting better systems in place and growing that way, offering better to my clients. And then now we keep talking about this thing where all of us are discussing how, because we all have kids and we want to not, we all use the analogy of the one kid that's really demanding and rebellious, and then you have 4 other kids who are great and wonderful, but you're ignoring them because you're dealing with rebellious brat all the time. We're like, you have to do that with your kids. You do not have to do that with clients. So and that gave us like, you know what? That's that kid. We want to focus on the good kids and offer them more because they're the ones that appreciate it. And so it kind of became our thing. So that's kind of our year of dealing with that right now. So it's kind of goes right along with what you said.
I'm glad to hear you finally bring that up because I've been listening along the way. And the one thing I didn't hear anybody talking about is every year you should be going through your client list and trimming the bad stuff off. It's how you're going to, like when you start off below and we all start charging too little, you're going to bring that average up by getting rid of the people that are sucking too much time and keeping you from actually reaching the things that you want to do. So.
And you hear that all the time. And for a lot of people, there is so much fear around letting clients go because they have this set income, and maybe now they have this set income and they're comfortable. They're not having to worry about paying their credit card bill or paying their grocery bill. And we come along and say, well, no, you have to, trim your client list and get rid of the clients that aren't a good fit for you just because you want to keep them from a revenue standpoint. But it's having that belief, and it's us saying, believe that it will fill. It may not fill the next day, but it will fill with the right types of clients. And so one of the things that we introduced, because I'm the person who says, no, we can't fire any clients, because what if and Steve is the one that says, no, we'll fill them. And I'm the one saying, no, we have to keep them all. So we made an agreement, and maybe this will work with the conservative people out there like me, that when we brought on a new client that was the right type of client, we then dropped off a client that wasn't a good fit.
I did that too.
The status quo, you're not moving forward, but you're also not moving backwards, because I have a really hard time moving backwards. So maybe that is a way that people are able to do that, is every time you bring on the right fit client, and if you bring them on for $1,500 a month, then you let go of 3 $500 a month clients who are bad, or you let go of a $1,000 a month client. You're still further ahead. You're not as far ahead, but you're still either status quo or you're further ahead. And maybe that'll be an easier way for you to get to the clients that actually understand your value.
And no one said that owning and running your own business was going to be easy.
Oh,
No
sure they
one
did.
said
Yes,
the
they did.
decisions you have to make.
They did
crowd
say
them
that.
out.
They just
They told you that.
lied.
Right? Nobody said the decisions you have to make were going to be easy.
Yeah.
But, for people out there who, might be listening to us, we're not the only people saying this, right? I mean, you go to any conference and you hear lots of people saying the same thing. So, maybe there's some truth to it. Maybe that's why all these people are saying the same thing. But nobody, I don't think, ever stands up there and says, this is easy, because it's not.
So here's a way that you could do this. Very easy. It's a very easy thing. It's a Excel spreadsheet if you want to do it. And it's one of the first things I ask the people that I work with to do. This column A is you list all of your, and now we have to spread up based. So what I call corporate customers, right? All your corporate customers or your bookkeeping customers, whatever it is. Now, if you have review and audit, I'd take them out, but corporate business customers that are notice to reader or bookkeeping, you list them all here. Then you make four categories, 4 columns, above 10,000. Another one is between 8 to 10,000, whatever the 4 different ranges that you want to do, right?
So fee ranges?
Yeah, ranges. Yeah, total revenue per customer, right? So you do that. So you have all of the customers on one side, and then you do your sorting so that all of the top ones, so that everybody's aligned properly. Then what you do is, because you're going to add them across, is there's a total amount of revenue. What you're going to notice is how many above 10,000, what the percentage of your total revenue. What you're going to find usually in the top 2 columns is about 60 to 80% of your revenue. Generally, that's what we tend to find, between 60 and 80%. The next 2 columns is about between 40 to 20% of your revenue. The next easy step, and we're not even looking at in detail of what's what or whatever, look at, do an image and going, these top 2 columns, let's say that's 60% or 75% of your revenue. And usually you might have 50 customers. That might be the top 10 or 12. The next thing is you go, am I using 75% of my resources to satisfy these customers and only 25% over here? And most owners could say, no, that's probably not true. That's a good way to start the process almost very quickly. And then all you do then is go to the bottom 25% of revenue, and then do what you guys are talking about, is you then go, which are the worst of the worst, and just take them off the list, because you're losing, because the resources based on the amount of revenue is even more dire now, because technically it's 25% of your revenue and you're using 50% of your resources over here. And this one particular customer, or these 6, are 10% of that. And think about that. You get rid of those 10%, that 10% of your resources go back to the top earners and make you more money. So that's a very easy way to do it. That doesn't take you a lot of time. You could do this once or twice a year. And for most entrepreneurs, that should be more or less. And if you have staff and you don't know the customers well, after you do that, talk to your staff and have a consult on who are the.
Absolutely.
Yeah.
One of the other exercises that that we always tell people to go through and that we went through ourselves was when you're trying to determine whether or not, so you're talking about you want to increase the number of clients that you value, that value you, that you want to work with. And so a lot of people have a problem trying to find who this ideal client is and what the person looks like. And so one of the exercises that we went through and we had our team go through and that we tell everybody to do is when you're working either with the client and on the client work, rate it 1 out of 10. When the client's number shows up on your call display, do you go, oh, great, I get to talk to John today? Or, oh my God, it's John, let it go to voicemail. Because that's going to tell you who the clients are that you like working with and who the clients are that you don't like working with. And all the ones that you've given, 1 to 3 or 1 to 4 out of 10, what are the similarities that you see between those clients? And all the ones that you've given 7 to 10, what are the similarities that you see between those clients? Now you're identifying who your ideal client is, but you're also identifying who the clients are that you don't want to work with. And that's just as important. And so that's a great way of being able to figure out who it is that you replace when you start to let clients go, who you want to replace them with.
No, it's really good. Yeah, that's a good exercise.
Matthew?
Real quickly, so Andrew Wall, quite a few weeks back, was talking about this new app or something or other that would go in and it would look at LinkedIn profiles, and he would utilize it before he would go to a meeting with a new client to be able to better understand that person's persona, if you will. I've always thought what you should be doing, instead of using that to go and pull up somebody before you're meeting with somebody, because that's after the fact. You don't know if you're attracting the right people or the wrong people. Use that to evaluate the good people that you like you're saying. Figure out what that persona looks like. Now do the same thing on the ones you don't like and use that to build your persona for marketing to try to create a better funnel to begin with. And
oh, that's a great idea.
Mhm.
And do you remember what that app was that Andrew mentioned?
of course not.
Okay, so we'll have to give a shout out to Andrew and tag him and have him.
I think it's called Crystal Notes.
Yeah, Brad, Brad should know it for sure. But yeah, Crystal Notes. Actually, that is it. And actually, so Linda ran it on me, and I was thoroughly impressed, how it was accurate. So.
And it evaluates you from your LinkedIn profile.
Yeah, I thought it was specifically LinkedIn, not anything else, but through LinkedIn. So.
Oh, okay.
It made me question, but it was legit.
Yeah, I did a demo on it too, and it was actually really cool. Yeah, it's kind of scary a little bit.
Okay. Okay, Steve, you got a new toy to read. Okay, so Louie, we've talked a lot about value. We've got about 10 minutes left. Value is probably one of the toughest things for all of us is you talk about, not spending time that your customers are going to pay for the value that you're able to show them. Can you give us any pointers on what are ways that we can actually demonstrate our value to our clients?
Okay. I guess with demonstrating value, before you can demonstrate value, you have to understand what the customer's wants and needs are and how that impacts their business. So to effectively hit those targets, you have to establish what I call a value conversation process, which means that you have to set up a series of questions. It's almost like an interview process where you set up a series of questions, and your whole purpose during that 1 hour meeting or whatever is to acquire knowledge, not give solutions. And the funny thing is, when we as professionals, well, the reality is we love to give solutions. We are always the problem solvers. And as soon as someone starts talking to us, we have a solution already for them, whether they've asked for it or not. It's in our brain. And the irony of it is that as soon as you start thinking of a solution, you stop listening, right? And that's a big problem, because for you to effectively understand the customer, you have to spend a lot of time of listening to them. So one of the things that we go through is go through a process of understanding what a value conversation is, what type of questions you should ask, the method of doing it. And this is the interesting thing. When you are effective in doing this conversation with your customer, you are actually showing expertise in asking questions. You show more expertise to your customer in the questions than you do in the answers. Because
Absolutely.
a person who has a lot of knowledge and expertise will then guide and direct the customer. And I've had some of my people that I've talked to, and they started doing this process, come back to them and the customers, you know, no CPAs ever asked me those questions before. No one's ever talked to me like that before.
Yeah.
And that's really important. So I didn't give you an example, but that's one of the key components. The other way to show expertise is to provide options and to show different options of how they engage with you, because options indicates all the types of services and it allows them to see how they want to interact. And sometimes they might pick a lower package, but then they get to see all of the things that you can provide. That's another way of doing it.
Okay, great. And just back to your first point. So for those of you that are in a niche or are thinking about going into a niche to offer your services, think about those questions that you want to have in that initial meeting, that because you are an expert in that industry, what is the terminology that you can use that's within the industry that a general or a bookkeeper who is a generalist isn't going to be able to answer or be able to ask using those words. So you want to be asking really specific things that, because you know that niche inside and out, you're going to demonstrate that you are an expert and you can speak their language, because that's a great way to show value. Absolutely.
I have one more thing that might help.
Okay, so we've got about, sure, absolutely.
Sorry, to help, because usually when I talk about value conversations, people they go, that's a great idea, Louie, and then they hit a brick wall and they have no idea what questions to ask. They just, boom. They go, can you give me a template? I don't like giving templates because then people just cheat and copy. But what I'd like to say is for us analytical people, there's 4 categories that you can use. Number 1, revenue questions. Revenue questions is top line revenue. And what that really, when you start talking about top line revenue questions, that is like strategic planning questions. And it's also future oriented. How much do you want to grow that next year? Your revenue was this. When you ask those type of questions, the customer is going to say to you and tell you what their strategy is to do that. Number 2, I call capacity questions or cost of goods sold questions. Capacity questions are things about, and don't talk about, you go, what kind of bottlenecks do you have in your production system? Quality control issues. And what they do is they end up telling you things that have a problem, right? The next one, so that's capacity, because if things aren't getting done properly, you got a capacity. The next one is profitability. Profitability is effectiveness. If they're not profitable, they're not effective in creating and producing value. So you find out, why didn't you make that profit this year? Why did you make too much, how did you make the profitability? Is it sustainable? And the last one, which is where we normally talk about, is working on your business. And those are like succession planning and so forth. So if you want to guide yourself and you hit a brick wall, develop questions, 3 or 4 questions in each category. That should help you start the value conversation process. Sorry, I just
went through not at all. Those were all absolutely great, great buckets to get people started, because that's usually the biggest challenge, is that people don't know where to start and where to start the conversations. So those were all really helpful. And I'm sure that there will be a lot of people who will wait until this goes into replay mode and then go back and fast forward. So I don't even know what the timestamp is. I guess it'll be 5 minutes before the end of the hour is where all these questions are. So no, those were, I thought, absolutely great. And in the comments, I don't know if you've seen the comments as they've been scrolling through. Most of them are comments, not questions, which is why I haven't been been reading them out, but lots of great points already in what you've shared. So we've got about 5 minutes left, and let's circle back to our topic. Our overall or wide-reaching topic tonight was building your dream practice. So we've identified, you know, that to build your dream practice, you start with, it doesn't matter what stage you're at, you can, from where you are now, move forward to build this dream practice. And although you've said, you know, you start with what your dream or what your revenue goal is, I'm going to take it a step back and have you try and identify what your life looks like and what you want your life to look like, and what does the practice need to make to support that life that you want to learn. Because, you know, if at the end of the day, we're not in business to make money, we're in business to give ourselves the life that we want. So have a look at, think about what you want your life to look like, and then what does that practice need to look like that you need to build to support that lifestyle, and start with your revenue number so I'm kind of doing a recap here just to see if we've missed any key things. So looking at your revenue, looking at what your numbers look like. There was a lot of discussion around understanding your metrics in your business, which a lot of people don't do. We do all the bookkeeping and we do all the metrics for our clients, but we don't do it internally. So making sure that there are some metrics that you can look at in your business to measure how you're doing. We've talked about value, showing value to your clients, so that as you let go of the ones that aren't providing support or the margins that you need to get to that dream number, then being able to replace them with clients that you are going to be willing to pay your price tag because you're showing the value. Anything else that is kind of an overreaching topic that we should cover in 3 minutes about building your dream practice?
Is that to me?
That's to you.
Oh, that's to me. Okay, I wasn't sure.
That's to you.
No, I think we've covered it. The only thing that I'd like to talk about value, just 2 things with value is, first of all, it's external from your practice. You don't create anything internally. The value is based on the outcomes of the customer, not about what you do. Secondly, value has 2 criteria. One is contextual. It's based on the context that it's in, and it's subjective from the customer's perspective, biases, and so forth. So I use the glass of water. A glass of water in the desert to a
Right.
man who's dying of thirst, and a glass of water to someone who has a flood in the basement. The value of the water is the same, but the context of what the value of that water is completely different, right? So those things you should always understand and keep that in mind when you're talking about value.
No, great points. Any last questions from anyone? So Afsana asked in the chat what is the name again? I'm not sure where in the conversation that was. I think it was around Andrew Wall's tool, which Michelle, I think you said was Crystal Notes?
Crystal knows.
Oh,
Knows. Okay.
Knows.
Okay.
Yeah.
I wrote that down.
I don't think there were any other questions that we didn't address. Any other questions from our esteemed panel? Okay, perfect. Well, we're at 8:59. We always try very hard to respect our 1-hour window that everyone joins us to share. So thank you very much, Louie. It was a great conversation. I think we had a lot of, you shared a lot of value, a lot of things to get everybody thinking about in the direction that they're looking for to build their dream practice. So just want to say thank you, and we appreciate you taking out the time to spend with us.
Oh, I had a lot of fun. Hopefully I didn't bore anybody too much, you know.
Oh, no,
Hopefully,
not at all.
you know, so, but this was great. This is fantastic. Fantastic. I enjoyed it. So thank you.
Excellent.
Right.
Thank you for joining us. Okay, everyone. So it is 9 o'clock. Thank you for joining us for another Wine and Whiskey Wednesday.
Cheers.
Hope to see you next week. Cheers, everyone. Have a great week.
Cheers.
Cheers. See you later.